Hello and welcome to the webinar, Sitting Down with the SMSF Association. I'm Darren Tyson-Chan, and we all know the SMSF Association National Conference for 2024 is just around the corner. It's going to be held in Brisbane next year in February. And I'm joined today by Peter Burgess, Tracey Scotchbrook, and Fabian Bussoletti to give us a taste of what attendees can expect from the event. Now, before we get stuck into it, I'm just going to paint a little bit of a background. The conference will have a continued professional development component of up to 48 hours on offer across the 2.5 days. It's being held between the 21st of February and the 23rd of February next year. So there's a lot of technical content in mind. And if we have a look at the sessions the SMSF Association team itself is presenting throughout the conference, it's really focused on the impact of recent and future legislative and policy updates. And to this end, there has certainly been a lot happening over the last 12 months. So we're going to have a look at some of the issues that will be covered at the event. Now, for those of you who have joined us today but have not been to one of these conferences before, it usually kicks off with Peter Burgess's trademark presentation now of the legislative and regulation update, providing us a stock take of the recent changes to the landscape and those changes which have actually been enacted, but also those that we're still waiting to see pass. But there's absolutely no getting around the fact that the biggest talking point for the last probably 12 months has been the proposed 15% tax on total super balances over $3 million. And the debate just continues. So we're going to start there, and I'm going to throw to you first. First of all, welcome and thanks for being on the webinar today.
Thanks, Darren. It's a pleasure to be here. Very busy time for the association, of course, as we prepare for the conference. So our preparations are in full swing. So really looking forward to the conference next February.
Yeah, busy time conference-wise and non-conference-wise as well. So I thought we'd kick it off today by just getting your take on how the government has handled this complicated issue to date.
Yeah, look, the association hasn't supported this tax from the outset. In our view, this is clearly a tax that's designed to fix a problem that will fix itself in the not too distant future. And to be frank, there are many other ways which the government could have dealt with this issue of large superannuation balances, which would have achieved much fairer and equitable outcomes, for everyone. So, but we do understand that it will be highly unlikely that the government will change their mind in relation to this $3 million tax. And we're also, we don't think there's enough support in the Senate crossbench to reject this tax outright. We think there is, an outside opportunity that we can make modifications and get the support that we need from the Senate crossbench to do that. So our focus right now is trying to improve this tax as best we can to try and make it a better tax. And that, is really our focus right now.
So if you're talking about making this a better tax, what sort of outcomes and resolutions are you hoping to see?
Yeah, look, we've always maintained that if you're going to have a tax on earnings like they're proposing here, well, then it needs to be based on taxable earnings. Because if you don't do that, and what's on the table right now is a formula which will picks up unrealised capital gains. So, if we're going to tax unrealised capital gains, you end up with some unintended consequences. You end up with some pretty erratic outcomes. So we're looking at trying to get it back to taxable income. Now, we're being told that's not possible, that the large funds, or some of the larger funds, are not in a position to be able to identify and report taxable income down at the member level, like self-managed super funds can. If we can't do that, well, what's the next best thing? Is a proxy for taxable income something we can look at? But we really do think to get rid of these unintended consequences and to avoid some of these bizarre and erratic outcomes, that we've all seen, plenty of examples of some of these unintended consequences that arise when you tax unrealised capital gains. So the focus right now is trying to, as best we can, remove unrealised capital gains from the calculation of earnings and get it back to taxable income, which is what we've always maintained. If we have to have this tax, if it's going to be a tax on earnings, let's make sure it's based on taxable earnings.
Now, one of the justifications for the formula that they're using is they want consistency, so they don't want the government doesn't want different sectors to be treated differently in the superannuation industry. But in other parts of the industry, we're actually already seeing that. So there doesn't seem to be a lot of consistency of approach here.
No, you're exactly right, Darren. And of course, we've just seen the non-arm's length expenditure rules. Hasn't been passed just yet, but it looks like it's almost inevitable that it will. It looks like we don't expect the crossbench to vote against those changes to the non-arm's length expense rules, which have just gone through that Senate inquiry, which I gave evidence at, and I must admit it. It was frustrating that we seem to be okay to have a different set of rules when we're talking about non-arm's length expenditure. So, different sectors being treated differently, but when we're talking about this $3 million tax, we've all got to be treated the same. There does seem to be some inconsistencies there with that. I should also note, in terms of what the other amendments that we're looking for the $3 million cap is indexation. I think we all agree that this cap should be indexed. And so we're pushing hard to ensure that this $3 million cap is indexed.
Now, looking at a more narrow focus, I suppose you could say, do you think the proposed cap has the best interests of the SMSF sector in its sights? And do you actually think it will achieve what the government is looking to accomplish by introducing this policy?
Well, again, I don't think it has the best interest of the SMSF sector at heart. We have to get it back to taxable earnings. We don't support this tax, but if we have to have a tax on earnings, then it must be based on taxable earnings. That's the only fair and equitable way to do this. If we don't do that, as I said, you end up taxing unrealised gains. So we think there are other ways that the government could deal with this issue, which could be fair and equitable for all members. So I would say that. Now, whether it achieves its goal, look, there's a big question mark about that. I think it's clear that some people will take their money out of super, so it will raise the projected $2 billion in tax that they're expecting. That there has to be a big question mark over how much revenue they're actually going to collect from this measure. And the other thing I would say is that the longer this money stays in super, the more tax they collect when members pass on and there needs to be death benefits paid. So forcing this money out, I'm not convinced is such a smart move.
Now, Tracey, I might just bring you in here because as the head of policy for the association, it's obviously been a very busy time for you as well. So welcome to the webinar.
Thanks, Darren.
Great to have you here today. Could you just give us an insight into how the association's been working with regulators and the government to make its position heard on obviously this issue, but plenty of others as well?
Yeah, look, there's been a lot of activity going on behind the scenes. Both Peter and myself have had various meetings in Canberra. Peter and I together in March this year met with Treasury and with government representatives just to talk through our concerns on this proposed measure. And since then, Peter's had a number of meetings. It's been quite a busy time, actually, in Canberra, just trying to have that close engagement to really try and flesh out these issues and to bring it to their attention to try and come up with a better alternative. Peter, did you want to talk about some of the activity more recently?
Yeah, look, we Scott Hay-Bartlam, the chair of the association, and I did pay a visit to Canberra and did meet with a number of politicians that day. So we met with the lower house TILs and also members of the Senate crossbench, and it's fair to say that they, were concerned about the taxation of unrealised gains and the lack of indexation in this measure. So, we are working with the Senate crossbench and we are working with the TILs to try and, as I said, improve this tax as best we can. So, yeah, back to you, Tracey.
Can I just ask, is it frustrating that the position seems to be no movement on this, no matter how much industry consultation that there is on this subject, that there just appears to be, this is the policy, this is the measure, and we're just pushing ahead with how it is.
Look, and that seems to be the tone at the moment across the board. We're seeing very short consultation periods and often very little amendment coming through in the bills from what we're seeing at the consultation paper stage or even the exposure draft stage. That final bill is very much mirroring what we're seeing through that process. So, yeah, it is a little frustrating because often we can see that there's good policy reasons for the different measures that government are trying to implement, but they could perhaps be done in a slightly better way. So, so we'd like to obviously see good policy set out. But yes, it can be frustrating sometimes, yes.
Peter, you obviously raised earlier in the discussion your concerns over the method of calculation, obviously, for this tax, and of course, the egregious nature of including unrealised capital gains in that calculation. That's one area that's obviously been a big talking point. If Treasury and the government doesn't take into account some of the issues like that have been highlighted, what's the sort of risk? Is there grave risk of there being plenty of unintended consequences arising from the measure that will actually be of detriment to everybody as it plays out?
Yeah, look, there's been plenty of examples, I guess, that we've seen which suggest that there will be unintended consequences for sure. One of the big issues that we can see with the calculation of earnings is just the unpredictability of this tax from year on year. So by linking this calculation to movements in investment markets, you can get some very wild fluctuations in the tax liability from one year to the next. And some of the cases that we've seen and the modelling that we've done, it can vary in the tens of thousands and in some cases hundreds of thousands of dollars differences in your tax liability from one year to the next. And that's going to make liquidity management extremely difficult. So the end result, I suspect, would be that people will end up holding a lot more cash in their fund than they absolutely need to, which will have a long-term detrimental impact on the performance of their fund. So, that's an issue that really I think is a significant issue with the model that the government is proposing around this calculation. Just the wild fluctuations in that liability from one year to the next, I think, is a big problem. But look, there's been some other examples that we've had some case studies that we've published over the last few months, some showing that an effective tax rate on taxable income well in excess of 50%. So, it goes well beyond what the government's trying to achieve with this. They keep talking about clawing back some of the tax concessions for these individuals that have large balances. In some cases, it goes well beyond that and claws back, well beyond those tax concessions, and individuals end up paying rates well in excess of 45% when we just look at their taxable income. Other cases that we've modelled where individuals have very, very large balances do have some taxable income in an income year and end up paying no tax under this provision because all that taxable income is eroded by the value of their investments that may have gone down during that course of the year. And again, this is another unintended consequence, we think, with including unrealised capital gains. You can have people, very significant balances, have some taxable income, don't pay any tax under this new measure, and that clearly wasn't what was intended with the government's measure. So lots of unintended consequences that we can see with including unrealised gains in the calculation.
There's some interesting areas of policy misalignment as well. And just to illustrate that, if we look at death benefits and reversionary pensions, where we have measures in place, quite rightly, with the transfer balance cap that would allow a spouse at 12-month period from date of death to restructure their affairs to comply with the transfer balance cap. Yet this tax doesn't provide for, or at least what we've seen so far, doesn't provide for any such adjustment. And indeed, any withdrawals that are made during a year would be added back and included in the income. So there's a disconnect there. And the other one to illustrate would be around disability, so disability benefits. those who are receiving compensation payments will likely be unaffected because of the operation of the existing total super balance rules, where those compensation amounts are excluded from the TSB calculation. So for those people in the main, that they will hopefully fall out, and that's the intention. But if you receive insurance proceeds as opposed to a compensation payment, and that tips you over, then we don't see a similar treatment. Treasury have acknowledged that the receipt of the insurance proceeds would not be included and carved out from the earnings, from the earnings calculation in the first year. But if your TSB is still over, it's still factored into the TSB. And if you've had any withdrawals, they'll be added back, included in earnings. And then, of course, you've got to calculate that going forward. So given the intention of what the insurance is meant to do, and the role that plays is very much the same as the compensation payment, yet they're treated quite differently.
Boy, it sounds like there's a lot of ground to be covered there. And I suppose getting back to the question I asked you earlier, Peter, whether or not the government will achieve its aims by introducing this measure. Well, based on what you just said, Tracey, it would appear that the simplicity that the government's trying to promote with the implementation of this is completely being defeated by all of these anomalies that you just raised.
Oh, I totally agree with that, Darren. And I think for accountants and advisors, helping their clients to understand how this tax is going to impact them is going to be really, really challenging, because where you sit at the beginning of the financial year, knowing what your valuations of your assets are going to be by the end of the year, sure, you can probably map out what you're going to do in terms of your withdrawals and things like that. But you don't know where you're going to sit come 12 months' time to be able to plan for that tax. And I think that makes it very, very challenging.
Yeah, and I'd just add to that this is not a simple tax, despite what we've been told. This is certainly not a simple tax. We've got negative earnings potentially that will need to be recorded and carried forward. We've got adjustments that are going to have to be made to to withdrawals and contributions so that we don't overstate the tax and so forth. So certainly not a simple tax, Darren.
No, and recent discussions, obviously, the more discussions that happen, probably the more issues are being raised with the proposal and the policy proposal itself. But you've obviously highlighted something very important, Peter, and that is the cash flow implications for SMSFs and individuals themselves, because obviously you can either pay it via your super fund or you can pay it individually too. And the mismatch between how your income is assessed and how your cash flow actually works is completely disparate by the looks of things. There has been a little bit of talk around, can we have a deferral mechanism so that, you don't, is there any sort of time frame where you can match it up a little bit better so that you don't have this massive liquidity problem and potentially having to sell assets and take action like that to actually fund your tax liability? Would you be supportive of that? Is the government making any sort of noises to say that, yeah, maybe that could be an issue?
Oh, look, it would certainly help. There's been, we haven't seen anything to date that suggests that that's going to be in the legislation when it does get introduced into Parliament. I think the only concession that we can see in the draft legislation was around, if you're late paying your Division 296 tax, you're not going to get hit with general interest charge. You're going to get hit with a shortfall interest charge, which is slightly less. So they seem to recognise, people may need a bit of extra time to pay this tax, and because of that, you won't pay the higher penalty rate initially. You'll pay a slightly lower penalty rate, but that's the only concessions that we've seen so far around that. We're still waiting for some of this detail, in particular the way this tax will work for members of defined benefit funds. That will be in the regulations. We are expecting to see the regulations released around the same time that this legislation is introduced into Parliament. We are expecting that it will be introduced to Parliament in early December, and at the same time, that's when the regulations we think will be released for consultation, and that's when we'll get our first glimpse at how this tax will actually apply to members of defined benefit income streams. So there's still a lot more to come here.
And no doubt that's certainly going to keep you on your toes of finalising your legs and regs presentation to start the national conference in February. Tracey, I know that we've discussed a couple of the flow-on effects and a couple of the anomalies that the association has identified already with this policy measure. But are there any sort of other flow-on effects that you're concerned about should the legislation be passed as is?
Yeah, look, we're already hearing from our members concerns around people who would not likely be impacted by this measure already having a bit of a knee-jerk reaction, I suppose. There's a real fear that seems to be emerging around this tax, and people looking to perhaps not make many more contributions into superannuation when that really it would be in their best interest to continue to make contributions to superannuation, or changing their investment decisions because they're worried they don't want to earn too much in their fund because they don't want to be subject to this tax. And that is really not a good outcome. People should be investing in a way that's in their best interest and it's going to help them achieve their goals and what's appropriate for them, rather than structuring things to try and avoid a tax. So this sort of shift in behaviour, this dynamic is quite concerning, and it's a difficult minefield for advisors to help their clients also with the current state of legislative uncertainty. So whilst we know it's coming, until it's actually passed and receives royal assent, it's not LAW law. So that is making it hard for advice in general, where clients will be impacted because of their situation today, or modelling looking ahead, they are likely to be impacted.
Yeah, that's really interesting, Tracey, obviously from an end client and from a trustee point of view.
Yeah.
Have you seen any concerns around members who are potentially from the audit profession, whereby the ATO currently already has a fairly laser focused on valuations and how they'd like that to work? I imagine that as we move towards the 1st of July 2025, when this policy is implemented, there's going to be an even more concentrated look at valuations, because obviously people are going to think that, oh well, if I can get a favorable valuation, maybe I can come under the $3 million cap. And that obviously is going to place more pressure on auditors, because, they're the ones who are going to have to vet proper valuation information and proof when they do the annual audit of funds. Has there been any concerns from the actual professionals themselves about, what does this mean for me? Is this going to create a massive minefield for me going into the future? Because there is so much onus on me doing my job properly that, like, what happens if something slips through the net and I don't want to face sanctions from any of the regulators or any of the professional bodies that I haven't potentially done my job properly?
Yeah, and there has been a lot of focus on our auditors and the documentation and the record keeping that they, what they're putting into their audit files to support the work that they are doing. So that's in valuations and sort of across the board, really. Valuations are a red button issue, and it is an area of focus that we know, and some assets are challenging to value. So things like the unlisted investments are one that are getting a bit of attention at the moment in particular. But we saw it when we had the last sort of changes that brought in the transfer balance cap and TSB, when we had those reforms back in 2016-17. Valuations were a big issue then, and I think any time that there's a big legislative change such as this, valuations are going to be under the spotlight. So for auditors, yes, that was an area of focus back then, and I think it will play out in a very similar way come 2025 and 2026 and so on, looking forward, because people either want to increase valuations or decrease valuations depending on kind of where they're trying to fit on the spectrum to sort of juggle the numbers.
Yeah, so I'd just add to that. I agree with Tracey. I think that there will be pressure on auditors, no doubt, and it's not just the low valuations that Tracey mentioned. You'll be individuals who are well over the $3 million mark. You would think that be looking for a high valuations come 1 July 2025, because that will reduce their earnings potentially for the next year, which is how this tax will work. So, there'll be pressure on auditors, no doubt.
That's a really interesting point, Peter, because a lot of the discussion has been around how do I get a valuation to get me below the $3 million mark, but there's all sorts of implications, obviously, across the board, really, for people who will be impacted or potentially impacted by this tax.
Yeah, absolutely. And as we just said, it's about, when you understand how this tax works, there is going to be those that will be looking for that high valuation rather than a low valuation as we get close to 1 July 2025, which is the first test date for this new tax, assuming it gets passed, of course.
Now, Tracey, this is obviously, I suppose you could categorise it as a risk area for SMSFs, or potentially, if some people would prefer to define it as a threat to SMSFs. Your session at the conference is going to have a look at some of these issues. Apart from that, are there any other sort of risk areas that we should be looking at and should be conscious of over the next 12 months and the short to medium term?
Yeah, so as I mentioned before, it's where we have legislative uncertainty that makes it really challenging for advisors and accountants to provide the necessary advice to their clients, and that we know is a problem already. Trying to make decisions today with the uncertainty looking forward. One interesting area which is raised its head a few times but is really getting some traction is around the target market determinations and design and distribution obligations. When this measure first came into law and it was active, we had some members reaching out with concerns around how these would actually apply directly to the SMSF, not necessarily the investments the fund is investing in, because of course the rules would apply there, which is what's intended. It's more around the establishment of an SMSF, adding members to an SMSF, or perhaps starting a pension. And the intention around these rules, and when we look at the Hansard, when Treasury gave evidence, when the original bill went before a Senate inquiry, they made it clear that these provisions are not intended to apply to an SMSF because of the operation of the product disclosure rules. But we've got this terrible grey area in the drafting of the law, because an SMSF can have a PDS, and what we often find with the document providers is one is automatically included within the documentation pack, and the trustees dutifully sign everything, adopt the PDS, and move on. And when it comes to a pension, well, there's a requirement that they have a PDS. So we then have a situation where the SMSF is then perhaps technically brought in to the TMD DDO regime because of the mere fact that they've implemented or executed a product disclosure statement. Now, the problem with this regime is it's intended to be a public-facing document. It's one to help consumers making decisions when they're looking to acquire a financial product to determine whether or not it applies to them, whether it's suitable for them. So given it's a public-facing document for investors, it doesn't make sense that the SMSF itself should be required to have a TMD. Indeed, the trustees and the members all being the same people, they're having to make high-level decisions around the investments. They've got the investment strategy obligations, the best financial interest duties that apply. So really all of the mechanisms are built in with the SIS obligations for a SMSF trustee. But what we're seeing out there in practice is there's some licensees who are starting to require advisors to obtain a TMD from their SMSF clients before they're allowed to advise. And this is starting to get a little bit of traction. When the legislation was first passed, we raised the issue with ASIC, but they're a little bit hamstrung because SMSFs are neither expressly in nor out. And so for their guidance, they can only really comment on what the law says. So we've been working with Treasury for some time, and it looked like we were going to be able to get a simple legislative fix through, but that hasn't happened. So we're continuing to engage on that. But what we're hearing is this is now becoming a growing problem for a piece of legislation that wasn't intended to apply to an SMSF. So the concern here is for advisors is whether or not they have a compliance issue, but technically they can't help a client with their TMD. Their licensing doesn't help them with that. They're not product issuers themselves. And their licensing is not going to allow for that, neither do the licensees. Document providers are not providing an exemplar, and it's probably a bit hard because, as we know, each SMSF is unique to its members and their individual needs. So this just seems like an administrative hiccup that just needs a simple legislative solution, but without it has a potentiality for some risk exposure for advisors for something that's not intended to apply. So that's something that seems to be getting legs at the moment, which is a worry. Red tape, yeah. The unmet advice is another area for SMSF. So declining advisor numbers, the access to financial advisors for simple single issue pieces of advice. So for the SMSF clients who are largely self-directed, wanting to commence a pension or make other decisions, being able to access a financial advisor if they don't have one already is really challenging. It's a really constrained market, and for the accountants and the accountants' advice, it's a really difficult space at the moment. The limited licensing model effectively is a dying model because we can't get new accountants into this licensed environment unless they've actually already got financial advice within their practice so they can come through and do that professional year requirement. So we're steadily seeing a decline in accounting numbers, really strong headwinds and challenges, and being able to get them back into the system. And then we start to overlay the issues around ASIC levies. We've now got the compensation scheme of last resort, which is an issue for licensed accountants, but also for financial advisors. So there's a real broad spectrum of issues around costs and red tape and complexity and uncertainty, I think, for the sector at the moment.
Yeah, they're great points you raise, and we might get back to that whole accounting issue a little bit later in the discussion. Because I honestly believe that it's a huge elephant in the room that's not actually being talked about at the moment, maybe because it's considered too difficult. I don't know, but I'm just speculating there. But it's certainly an issue that should be unlocked, and I think a lot of the pain points that people are suffering, as you just said, Tracey, could be solved with a better solution there. Just back to your point about the anomalies of calculating what your total super balance will be, can I just ask, is there going to be consistency across the board as to how to calculate your total super balance if this policy goes through? So in all circumstances, will your total super balance be one consistent number, or will your total super balance be manipulated, for want of a better term, for this policy versus other things such as, whether or not your TSB comes under $500,000 so that you can take advantage of the carry forward concessional contributions provisions. Is it going to be across the board? Are we going to see two different types of calculation? How is that going to work? And has the government actually given any sort of guidance that, no, this is it, and there'll be one standard measure?
So from what we've seen so far, the TSB as it currently stands will remain. And as you highlighted, there are other measures that are intrinsically linked to a person's total superannuation balance. So as it's legislated now, that will remain and will continue to apply to those measures as they do today. What we see with the $3 million cap are modifications to the total superannuation balance. So I think where Treasury started on this was looking at the total superannuation balance. But then as issues were flagged and it started to get further down the road, they recognised that it doesn't work as the standard TSB. So we then start to talk about all these modifications that need to be made with taking away and adding in to come up with the calculation.
Yeah, that all sounds very straightforward to me, Tracey.
Yeah, doesn't it? Simple. It's easy, Darren.
Of course it is. Now, Fabian, you've been waiting very patiently while we've been having these discussions. So it would only be right for me to introduce you to the webinar now and to include you in these discussion points. So welcome, Fabian. Thanks for joining us, and it's great to have you join in on the discussion. And we're going to get back to the $3 million soft cap again that we've been talking extensively about since the webinar began. And of course, probably most importantly, and touching on some of the issues that you raised previously, Tracey, Fabian, your session will be an interactive workshop addressing advisor and practitioner concerns about how to navigate this $3 million cap. Just on your experience so far, what do you think is most concerning for delegates that you're anticipating a lot of questions to be directed at?
Yeah, look, I'm not sure that we'll get any one singular question. I think there's quite a number of questions, and many of those have been touched on through the conversation so far. But I think we're going to get questions that range from simply wanting to understand how the tax works and what clients will be impacted, to understanding how they'll be impacted. So what do the actual numbers look like for client scenarios? And then you'll have some people who are probably sort of further down the path and wanting to consider what alternative strategies might be available, or alternative structures that advisors can share with their clients to help them manage through the introduction of this new tax. And then you'll obviously have the fundamental question, which I think was touched on earlier as well, that around whether for someone who's impacted by this new tax, whether or not superannuation is still as attractive a vehicle for holding their wealth in, for those who are impacted at least. So, so look, I think there'll be loads of questions. And I think as has been sort of already canvassed, it's a theme that this whole $3 million cap will be a common theme across a lot of our workshops and presentations. So if I think about the session that I'll be co-facilitating alongside Peter Crump, and from the $3 million tax perspective, we'll be looking at who's going to be impacted by the tax. We'll be looking at how the tax will be calculated. So I guess intrinsically linked to that discussion is looking at how the total super balance will be applied. And then we'll also turn our focus a little bit on what happens when a member dies, and the potential impacts of that on their beneficiaries. So I guess that's probably the focus from a $3 million tax cap perspective in the workshop that I'll be co-facilitating. But there will be other sessions that also touch on the tax, providing insights and analysis as well. So I think we spoke earlier about the issues around property valuations and liquidity for SMSFs that hold property, particularly for farmers. And so we've got a session that will specifically be covering the complexities of integrating farming assets into an SMSF's investment strategy, which naturally will touch on the implications of the new tax. And there'll be other sessions as well that touch on a number of the questions that I posed a minute ago. So look, I think there'll be a few questions really, rather than any one singular main question. But I think that most of those questions should hopefully be addressed or well addressed throughout the course of the conference.
Fabian, just from what you're seeing now, and obviously in anticipation for the session that you will be hosting, are you seeing a lot of confusion around this as far as practitioners go, as to how to go about it, what it means, all of those things?
Yeah, well, look, I mean, based on some of the comments and questions that I've seen and received so far, I mean, there seems to be a fair bit of confusion around the tax in itself. And look, to be fair, I mean, it's obviously not yet law, and it won't take effect for some time. So I suppose there'd be many practitioners who haven't yet turned their mind to getting into the weeds and analysing the specific details. I mean, it's fair to say that the high-level concept that there's going to be a new tax to be imposed, and that tax will be imposed on those who have total super balances above 3 million. I think that part's relatively well understood. But it's when you get into the mechanics that I think that confusion and complexity arises, really. And if we take a step back, it's probably worth recognising that, as the association has previously stated, that we already have a relatively complex superannuation system. So we already have, a transfer balance cap, which will limit how much people can transfer into retirement phase. We have this total super balance concept that as you've just touched on, and as per Tracey's comments, applies at different levels to determine an individual's eligibility for, different strategies, such as, being able to make contributions and bring forward caps and so on. So to some extent, I think there's already a deal of confusion caused by the current system that we're operating under. And now we've sort of got to overlay that with this new tax, which I think is only going to add to that complexity because, whilst we are going to be applying the total super balance definition to work out liability for this tax, we then have this sort of modified total super balance definition, if you like, with a number of additions and subtractions that we need to factor in order to work out an individual's superannuation earnings, right? And then, we already have a $1.9 million cap. We've got a $500,000 limit for, catch-up concessions. And now we have to also bed into that sort of thought process this new $3 million limit. So I think there's a fair bit of complexity. And so I guess if I sort of try to bring it back to the workshop that we're running, specifically that I'll be co-facilitating, we will also be trying to put some of that confusion to bed around the current world. So we'll be looking at the concepts of transfer balance cap and the concept of a total super balance, the way they currently operate. And so we'll have a couple of case studies to highlight some key life events, but then overlay that again in light of the change or the introduction of the new tax. So yeah, look, I mean, to come back to your questions for a long-winded answer, I think there is a great deal of complexity, which will only, I think, be exacerbated by the introduction of that new tax or this new tax.
Fabian, you raised a really good point there with one of your comments around confidence in super, and how one of the things that one of the questions being asked is it still really worth putting money into super? Is it still an effective savings vehicle for my retirement savings, given this new tax, and potentially I'll be caught by that and I'll be giving more money to the government as a result? I know this point gets raised whenever we have a new measure and significant measure affecting superannuation, but are we seeing this manifest more this time around? And is it a worry to all of you that you're already seeing sentiment like this being expressed?
Well, look, I think it's as you say, any time we have significant changes to the system and to the way the structure is taxed, that question will arise. I mean, we had the introduction of a superannuation surcharge many years ago, and certainly that was a question that was front of mind back then. And so it's no surprise that question will come up. But look, I think that ultimately it'll come down to an individual case-by-case basis where there'll be some analysis required. Consideration of alternate strategies working alongside someone's super will be something that will need to be considered in some cases. But yeah, perhaps not surprised that question's being asked, but one that will require analysis on an individual basis, I would have thought.
Is anybody else sort of concerned about what we're sort of seeing already? Because you're not the only one that's raised this, Fabian. I've heard other discussions that has been expressing the same point.
Oh, look, I just add that changes like this do have an effect on confidence in the system. It's one of the reasons that we do support the objective of super, which we'll see that passed into law soon. We think that will help grow confidence in the system. We think it's a good idea that everyone has a shared understanding as to what we're trying to achieve with the super system, and this will be, by having this objective, it'll be another sort of hurdle, if you like, that policymakers and future governments will have to go through when when making changes to super. It's not to say that these changes won't happen, but we think that type of thing can only help to grow confidence in the system, and confidence is a really important thing. We're trying to encourage people to make voluntary contributions, to put money away for their retirement savings, and clearly, they're not going to do that if they don't have the confidence in the system and confidence that the rules aren't going to change. So, it is a concern, and it's one of the other reasons that we don't support this tax, as Fabian's alluded to. There's already caps in play that are intended to deal with these large balances over time that do put obviously restrictions on people being able to contribute large amounts. So those caps are already there. We need to give them time to do their job, and introducing a new cap like this will just make what is a complex system even more complex.
Now, I'd actually like to go a little bit beyond the $3 million cap now, because we're probably all sick of talking about it for the last 45 minutes. But I'd like to come back to one of the points you raised, Tracey, and that's around the role accountants can play with the shrinking number of advisors that we see right now, the potential dysfunction of the limited licensing regime, and how that's probably not going to be a solution going into the future. Now, Peter, I know you've been, and the association has been, not potentially critical, but has suggested that the quality of advice review should have looked at the role accountants can play in providing advice to all Australians who are looking to seek advice and probably desperately need it too. Of course, the more practitioners you include, by nature, potentially the cost will be driven down as well, which will make it more accessible. Is this a point that you will continue to pursue, even though the report has been finalised and obviously Stephen Jones is looking at implementing recommendations already via law?
Yeah, absolutely. This is an area that we have been working very hard on to come up with a workable solution for quite some time. The James Review highlighted that there was a need for equivalency around a single disciplinary model for accountants and tax agents. So we've achieved that in the main for our financial advisors now, with the move away from the Tax Practitioners Board to ASIC for their tax registration. And we see that all housed under ASIC now. And so we need something similar for accountants. Certainly those who are looking to provide broader financial advice services would remain within the licensing regime as it currently stands. But there's a couple of anomalies that do need to be looked at. And the first one is around the recognition of what is a tax agent service. So there's a real chasm, if you like, between the tax providing tax advice and what's a tax agent service, and then straying over into financial advice. So, for example, we look at year-end tax planning, where an accountant or a tax agent will sit down with their client. They might have a number of different business entities, their personal tax, and they'll look at what their earnings are for the year, their cash flow, liquidity requirements for their businesses, the capital investment. Are we going to fund internally, or we're going to borrow? All of these kinds of decisions come into that complex planning that accountants and tax agents undertake with their clients. This will also include their remuneration, what pay are they going to get from their entities, how it's going to be paid, and naturally is going to include superannuation. So you do modelling, different range of different scenarios, which would include different contribution amounts for different family members. The accountant knows that they've got a self-managed super fund, or they know they've got a colonial first state account, or whatever the case may be. You can't unknow what you know about the client. So when we start talking about specific contributions and making a recommendation, I've mapped out these 10 different strategies, and I think strategy 3 is the best one for you this year. You've made a recommendation, and this is the problem, because it is a tax agent service that's been provided. But then when you look at the ASIC website, it says, although you may have provided a service as a registered tax agent, you may still be captured as providing financial product advice. If they're not licensed, then we've suddenly got a problem, because they've talked about a discrete contribution. And to me, that seems quite nonsensical and dysfunctional. Accountants need certainty to provide that sort of advice that they do as a part of their in the ordinary course of their tax agent business. So this is an area that does need to be mopped up and to provide some certainty so that accountants can actually properly go and give that advice with confidence and not have the fear of, have I provided financial product advice? Am I going to be in the gun and have a liability perhaps down the track should ASIC have a look at anything and have a look at it as being the provision of unlicensed advice. Now, we haven't seen that happen to date, but that doesn't mean to say that it can't happen. So it's a hidden risk, I think, that's sitting out there for the sector. Then separately to that, we touched on before about accessibility to limited pieces of advice, and financial advisors they're run off their feet. They've got more clients than they can deal with in many circumstances. So the capacity to take on new clients, and particularly where they're talking one-off pieces of advice, maybe a specific limited piece of advice, they just don't have the capacity. It's not that they don't have the will or the desire to want to help people, but it's a capacity issue. It's also a cost issue for the client as well in order to be able to receive that advice. Current environment too, we're also seeing situations where the advisors can't provide limited advice because of their licensee requirements, may require them being a new client to do more comprehensive advice for that client. So it's a real pain point. So with the quality advice, we've seen recommendations around the super funds being able to provide a certain suite of limited advice, and that makes sense. And the minister is on the record on a number of occasions saying that we need to look at the retirement mountain that's coming and be able to have the advice available and accessible to people, and we support that, and we understand that need. But the whole piece that's been missing here is how accountants fit into that, fixing these tax agent issues, but also coming up with a limited licensing model, like the James Review mentioned. And incidentally, the James Review recommendation was included within the terms of reference of the Quality of Advice Review. But unfortunately, despite a number of meetings and consultations and significant amount of material and resources, case studies that went into the Quality of Advice Review, we really ended up with nothing out of that, which was disappointing. Sympathetic to Michelle, that was a big remit that she had with that review, but we were very hopeful that we'd at least get something for the accountants, and unfortunately that didn't happen. So the work in that space continues because, as I mentioned, limited licensing, for someone to get in the gate, unless they've got licensing in their practice, they can't even get to first base because there's no one there to support them through their PY. We've got the education requirements for new entrants. There's a raft of issues. Not to mention the ASIC levy. That's a huge issue for our financial advisors who are providing these full-time services. For accountants, it is a part of what they offer. It's about being compliant about the advice that they provide. And these costs on top of the licensing are starting to become quite a significant mountain to climb. And is it any wonder that we've seen so many of them exit the advice space?
Now, while it hasn't been an issue that's been raised out of Michelle Levy's review, can we draw any sort of positive message or any sort of optimism from the fact that it was actually the Labor government who introduced the limited licensing regime? I still remember, as per his projections, it was Bill Shorten was the minister there. And when he made the announcement, I made this mental note that he said that it would introduce 10,000 more advisors into the advice space. Now, even though his number was desperately inaccurate, but given the sentiment, can we have any sort of optimism that if that was the original motivation to introduce a limited license, would they go back and review it, seeing that it was a Labor policy, and regardless of whether or not it's in the QAR or not, would they go back and have another look at that simply because it didn't achieve what it was supposed to? And it's not achieving it because it's not working properly.
Yeah, so look, it was great policy intent, right? What they were trying to achieve and was a fantastic idea, and making sure they had the proper consumer protections and frameworks in place. Tick for endeavour, but unfortunately the structure of it and it doesn't work, and it's too constrained. It creates too many issues. Look, we keep raising it. They're keen to hear from us when we raise it, but we need to get it beyond that and actually get it on the policy agenda and actually get it moving forward. So even though it's not in the quality advice review and because of that, it won't feature in these tranches of reforms that we're seeing to start to flow through. Now we've got those tranche one out for consultation at the moment. It's one that we'll still fight the good fight, because there does need to be a solution. And those sorts of numbers are very achievable if we get the right model. And it will be good for clients, good for SMSFs, and more widely.
I would actually say that it's a better solution than broadening the amount of people who can give so-called financial advice that some of the recommendations has come up with, because this is really a practical solution and a workable solution as well for most Australians. Now, I know one of the things on your mind at the moment, Peter, another front that you've got to raise at the moment has got to do with the TPB misconduct provisions, and potentially how there's a bit of a flaw in how that whole structure has been proposed. Can you elaborate on what your concerns are and potentially what a better solution might be?
Oh, look, this is one that's come up pretty late in the piece, Darren. So this was a late amendment made by the Greens as part of the PwC scandal, some of the measures that we've been putting in place to try and prevent that. The concern is that there wasn't any consultation around this, and we can see there are some, adverse implications of what some of these changes have been put forward. So we would have liked to have some consultation, and we haven't. So, and we do have concerns about, what's been put forward. I know, Tracey, you've been doing a bit of work on this, so perhaps I'll hand to you to fill in the gaps.
Yeah, so the underlying bill itself, there was quite a lot of consultation that was had with the stakeholder group for the Tax Practitioners Board, which includes a broad spectrum of professions and associations, from accountants, BAS agents, through to lawyers. So it's financial and even financial planners who've got tax agent registration. And so there was quite a lot of consultation that went around that bill. And then separately, we have the Senate inquiry into PwC that's happening. Now, that inquiry is only partway through. It is not due to deliver, I believe it's until the middle of next year, its final report. And I don't believe an interim report's been issued. So these amendments came through as quite a surprise to industry, because there had not been any level of consultation on these amendments. They weren't part of the original bill, and they weren't a part of any other body of work that had been put out to public consultation or through the stakeholder group. So that in itself is concerned. There's significant changes, one of which is changing the who can be a board member of the Tax Practitioners Board. And the intention there is to limit Big Four firms like the PwCs from having a position on the Tax Practitioners Board. Now, the TPB have been acknowledged as being at the forefront of the PwC issue and shining a light on it. So I found it quite fascinating that we'd then start to see some measures around that would start to change the composition of the board. And I think it's board governance that becomes really crucial when these sorts of issues arise. So the limitation will be that anybody who has who's currently employed a partner, so employed as a senior manager, I should say, they're either a partner or director in an accounting firm, or still receiving an income from that firm for a period of up to 6 months after leaving the firm, cannot be a member of the TPB board. So where they have more than 100 employees. There's a lot of firms out there that would have more than 100 employees that are not of the size scale of PwC, and I straight off the top of my head can think of a number of different firms which at client facing would look like small accounting firms, just that they're an amalgamation under a common ownership of a number of small practices that have come together, for example. And I think it's important that you have good cross-sectional representation on the board. So this is concerning where we understand the intent, but this is concerning sort of what this will look like going forward. The other one is around reporting significant breaches. So an individual will have an obligation to report themselves, and I think that's appropriate, but it's quite broad in saying that another tax agent has an obligation to report someone else where they're aware or ought to be aware that there's a significant breach has happened, and there's time limitations. It's within 30 days of becoming aware. So this then starting to bring in whistleblower provisions. So how's this going to work out with, say, legal privilege? What point is someone meant to know? What about protections for a whistleblower? You could imagine someone within a firm having an obligation subject potentially to a penalty for failure to report, and not having any sort of whistleblower protection. And then the other side of it, if you flip it, is what about protections for practitioners where there's a vexatious claim, perhaps a disgruntled former employee? There's a range of circumstances where a complaint could flow. What are the protections for the people in those circumstances? So policy intent, I think, is strongly endorsed by industry, but the lack of consultation means that this is drafted so broadly. There's a real risk for advisors as it stands, tax agents as it stands at the moment. We understand that the Tax Practitioners Board are working on some practical guidance on how they see these operating under their remit. And they will consult widely on that, and we look forward to having the opportunity when that arises to consult on that and sort of see where those measures land. But it is a concern because the law is quite broad as it has been passed.
Well, thanks for filling us in on that subject, Tracey. We've actually run out of time on the webinar today. So I just thought I'd reiterate once again that the SMSF Association National Conference for 2024 is going to be held in Brisbane at the Brisbane Convention Centre. And it's going to be held from the 21st of February to the 23rd of February. And just a reminder that the early bird registration ends on the 1st of December. So make sure, if you're listening and you want to register, that you will take advantage of that early bird, as you can see on screen now. Of course, the theme this year is Level Up, and no doubt if you attend the sessions, you will be leveling up your technical knowledge as you go. But anyway, as I said, unfortunately, we've run out of time. I just want to thank very much Peter Burgess, Tracey Scotchbrook, and Fabian Bussoletti for participating in the webinar today. I think we've had some great discussion points here.
Thanks very much, Darren.
Thanks, Darren.
Thanks, Darren.
And of course, I'd just like to point out that this will be Peter's first national conference as CEO, so we're all looking forward to that. And if you're going to register, please do register, take advantage of that early bird rate, and we look forward to seeing all of you in Brisbane in February. Thanks very much for joining us today. We hope you've enjoyed the discussion.